Hi, this is Terry, Chapter 11. We're doing contributed capital, getting towards the end here. The first thing your book goes through is the advantages and the disadvantages, the advantages and disadvantages of a corporation. The idea of a corporation, as opposed to a sole proprietor or a partnership, is it's a separate legal entity, so it can a corporation can enter into contracts, sue, and be sued. It has limited liability for the investor, that the only thing they can lose is the value of their share of stock. Banks are more willing to lend money to corporations because sole proprietors, those sole proprietors have a mortality issue, the fact that they die. So a corporation with its continuing existence is a better deal to lend money to. It's very easy to transfer the money. You just sell your share of stock. Mutual agency is a disadvantage of partnership, that when one person enters into a contract, everybody in the partnership is bound by that contract, so you don't have that mutual agency problem in a corporation. You have professional management, typically in a corporation, that are running the business, as opposed to a sole proprietor who may or may not know what they're doing. Disadvantage is a lot of government regulation. As soon as you become a corporation, then you have certain reports that you have to fill out. You have to have an annual meeting. You have to have a president, vice president, et cetera, et cetera. If you're publicly traded, then you have to produce all your financial reports and give copies to the SEC, et cetera. The big one here issue is the double taxation, and the idea is that if a corporation generates net income and then they distribute those dividends, that net income is taxed, and then the money that's left over is distributed as dividends. The investor that receives those dividends then has to record them as dividend revenue on their personal income taxes, and that same dollar that just got taxed as part of net income then gets taxed here at the personal level. They have to record that as revenue. It goes in front of Congress all the time to try and get rid of this double taxation. The idea is that if investors didn't have to pay taxes, then they would take those dividends and reinvest in companies. If they do reinvest in companies, then companies grow bigger, they hire more people, they pay more payroll taxes, they sell more product, so they pay sales tax. Those people then that work for the company now have jobs, so then they go out and purchase. So the idea is, if you got rid of the tax on the revenue, the federal government, the Treasury, federal Treasury, would actually make more money, but it never quite gets passed. All right. Dividends have 3 dates. The first date is the date of declaration, and the issue here is the board of directors will declare dividends, and at that point then you declare dividends and dividends payable. The dividends being the reduction of owner's equity. So when assets equals liabilities plus owner's equity, we're talking about the dividends account here, and then the accounts dividends payable is your liability. It goes up. Then the next date is the date of record, and with the date of record, those are the people that are going to receive the dividends. So the date that the board of directors declares the dividends, it takes some time to get a list of everybody who should receive those dividends. And any shares of stock sold in between that time period, then the person selling the share of stock would adjust the price, knowing that the person buying the share of stock up until that date is going to receive the dividends. Then after that point, then the third one is the date of distribution. That's when you take the liability off the books and record the cash. Okay? Let's move down a little bit here. Dividend yield is the dividends per share divided by the market price. and I think we can just read this one, that dividend yield is a way to measure how much cash flow you're getting for each dollar invested in an equity position. In other words, how much bang you get for your buck. The idea here is the dividend yield is going to be the return on investment for the investor. So that's going to be the percentage they earned by investing their money. So from corporate side, you would give a dividend yield percentage. Return on equity then is net income divided by average equity. Average equity would be the January 1st plus the December 31st divided by 2, so you take the balances. It's a measure of a corporation's profitability that reveals how much a profit a company generates with the money shareholders have invested. And this second part is probably the main part. Return on equity is useful comparing profitability of companies in that of other firms in the same industry. So if you're trying to decide whether or not to invest in a company, you look at their equity and you look at the relationship of how much net income are they generating from that equity. And so if you're looking at, one company's doing 8% and another one's doing 11%, then obviously the 11% is a stronger company. That may be where you choose, one of the factors you use in choosing which company to invest in. And again, what you want to do is compare this to similar industries. The price-earnings ratio is the big one. And that's probably the most important one, so there's quite an explanation in there. But what I really would like to get to is just, again, this last part. If a company was currently trading at a multiple price earning of 20, the calculation comes out to 20. The interpretation is the investor is willing to pay $20 for every dollar of earnings. So what we're getting to is the price-earnings ratio is the confidence the investor has the market or the investor has in that company, and that in turn tells you what price you should be paying for those shares of stock. So one way of trying to decide is the stock price too high or too low is to look at this price-earnings ratio. Stock option plans, I'll give you a quick rundown what happens. Let's say that the current stock price is 20 and management wants you to get that, or board of directors wants to get management to get that stock price up to 30. What they'll do is offer a stock option price here at 25. So if management can hold down costs, generate new ideas, whatever it is, and get that stock price up to $30 per share, then immediately, as soon as they hit that $30 mark, then the upper management that was given that stock option plan can turn around and buy those shares of stock for $25, which they could immediately turn around and sell and make a $5 profit, or the fact that they bought something that's worth $30 for $25. It's just a means to motivate management to do a good job in running the company. Eisner from Disney is probably one of the most famous, that when they were trying to throw him out of Disney, before he left, he exercised all his stock option plans and just made millions and millions and millions of dollars overnight simply because he exercised his stock options. All right. The next part is the owner's equity section, and what we want to look at is contributed capital represents the original investment in the company. So this whole section is all about the investment in the company. Retained earnings then is exactly what it's talking about, or what the title says. It's the earnings that were retained in the business, and obviously then that's from an operating standpoint, not an investing standpoint. So we're going to talk about these in treasury stock here in just a second. So let's move down. When a corporation decides that when you create a corporation, you go to the state, and at that point you get authorized. It's done at the state level, so different companies will look to different states to get the most favorable treatment. favorable tax treatment. That's why you'll see certain types of industries will, maybe out in South Dakota, other industries maybe in Connecticut, etc. So it's all based on getting favorable tax treatment on their earnings, etc. So let's say that the state authorized $500,000. Well, then a company may issue $200,000 immediately to form the company, and they'll take $300,000 and hold that into reserve. Whoops, get my decimal. Oh, right there. Okay. As time goes by, then a company may repurchase its own shares of stock from the market, and there's several reasons that you would do that. One is the fewer shares out there, then you're talking about a supply and demand issue, that if the supply is low and then the demand will be higher, that'll help raise the price. It's also an issue that if there's fewer shares of stock and you declare the same amount of dividends as you did in the previous year, then each shareholder gets a higher amount of dividends, which will tend to make the stock price higher. So there's a lot of different reasons why you would want to buy your own stock. Those are just a couple of them. I want to jump down here to the lower section, then I'll come back up. The common shareholders, then, by definition, are the residual owners. They're the ones that get the last, they get the breadcrumbs. So if a company bellies up, the first people that get money is the government, and then once the government gets their taxes, then creditors, then preferred stockholders get their money, and then finally, when it's liquidated, common stockholders are the last ones. They're the residual owners. Par value, most companies, by the statutes of the state, there's a par value. So they may issue a share of stock that has a $10 par, but the market right now is $25. So they would receive cash of $25. There's a $10 par, so the $15 goes into an account called PIC, which is short for, and this legally would be $10 to the common stock account for the par value. Then the paid in capital is paid in capital in excess of par value, common. And since it's such a long name, of course, we just say PIC. The par value here, the idea is that that's the legal minimum. And it was quite an issue in the Depression because people had all these shares of stock, but when the value of the stock went below 10 and somebody was trying to sell it for $1 just so that they could eat, all these wealthy people, they were trying to eat, they couldn't because legally you can't sell it for anything less than $10. So at that point in time, even though people might be willing to have bought it for $1, they legally couldn't. So those people were broke, they jumped out of buildings, etc. Because of that, then a stated value is another way that is everything's recorded just like it is under this par value. So everything's recorded this way, but there's no legal minimum value. It'll just be a $10 stated value. A third way of doing it is the no par, and there you would record the cash of $25 and the common stock at $25. And there'd just be no PIC account because it's whatever dollar value the market is. Let's get rid of my marks here, and while we're here, let's talk about what happens if we issue, instead of issuing for cash, so instead of getting cash and common stock, and then turning around and buying a building and paying out cash. What if you simply sell a building for, let's say, $100,000 and then issue common stock for $100,000? And the question is, if this building was worth $110,000, should you be recording the building at 110, or what should you be doing? And rule number one is, if you know the value of the common stock, then you would use that value. The idea here is if this common stock is being publicly traded, then you can open up the financial papers and you can see exactly what the dollar value is that the market has put on those values for those shares of stock. Therefore, if somebody reaches into an agreement that they're willing to accept $100,000 of stock for their building, then on their books they're going to record whatever they record, but on your books you're going to put that building as $100,000 because that's what you gave up was $100,000 of stock. If that stock has not been traded, it's a brand new issue, then what you would do is you would record this at the fair market value of the building, and then you would put the excess into the PIK account. So that's rule number 2, that if you don't know the true value of the stock, then you have to use the fair market value of the building, which is not as good of an indicator because that's somebody making a guess, making an appraisal value. All right. Let's jump up here and do the preferred stock. The preferred stock is another way that you can issue stock that you get preference to dividends. So the board of directors declare the dividends, and the preferred shareholders get their money first. When these shares of stock are issued, then they'll have a par value and they'll have a stated rate. So here we have 7% $100 par. So what we're guaranteeing is that they're going to make $7 per year on this share of $100 par preferred stock. The issue then becomes, is it cumulative or non-cumulative? Because if the board of directors issues, let's use simple numbers, and let's say they issue $10, then the preferred stock gets their $7, $3 goes to the common shareholders, goes to them as dividends. If it's cumulative and the board of directors does not issue any dividends, does not declare any dividends in 1 year, and then next year, let's say they declare 25, well, if the dividends are cumulative, then they've got to pay off the $7 from the previous year and $7 for the current year, which is $14. Then the other $11 would go to the common shareholders. If it's non-cumulative, then that first $7 here is just gone. That if any given year you don't declare dividends and it's non-cumulative, they lose those the right to receive that money. So if it is cumulative, the money goes into arrears and then is paid off at a later time. Let me get rid of all the red marks here and look at this. Another feature is that it can be callable at, say, 103. Well, that means that the companies can buy it back at 103% of what the par value is. The problem with that is that if you are trying to lock in that 7% because you're a pension fund and you're going out and buying preferred stock of other companies, you want that guarantee and you don't want it to be callable, because if it is callable, then you've lost that guarantee of 7% return. So callable is not a good thing for people who are trying to lock in for a long-term investment. If it's a short-term, you're buying this short-term, this preferred stock, then that's not much. It's not a big deal because you'll get your money while you can. Convertible then is at the discretion of the owner. The people buying the preferred stock can have the right to convert into the preferred stock into common stock, and there'll be a conversion rate that's given. So maybe it's something like 10 to 1 that they get 10 shares of common stock for every share of preferred. The problem with this is once those shares of stocks are converted, then you can't go backwards. Once they're converted, it's a done. It's a one-time deal. All right. Then the last item here is our treasury stock, and the treasury stock, that's when you go out and buy your own shares of stock, and so you use the fair market value. So you would record treasury stock, and let's just use simple numbers and say $20 and cash 20. Oh, let's move this over. All right, so now we've got $20. So it may have a $10 par value. The price has been, going up and down, but at the time that you bought it, then you paid $20. So that's what you got to keep track of. We're talking about keeping track of what our cost was. Then later, if you would go out and reissue these shares of stock, and let's say at the time that you reissue it, you get $23. Well, if the shares of stock were bought at 20, then the treasury stock has to come off the book at 20. Now what you have is a PIK account treasury, RY, that represents $3 more. So it's really funny because when you talk about treasury stock, you're talking about owner's equity going down, but when you have a PIK treasury, owner's equity is going up. So treasury stock is a debit to increase the stock, and it's a negative equity, but this PIK treasury is positive equity, and that's just a little bit goofy. There's one more little nuance, and I'll write up at the top here where I got a little bit of white room. What happens if you would turn around and issue more of the stock that you bought at 20, but you only got cash of 16? So again, the treasury stock has to come off the books at 20. Well, one thing you can do is, since you made a profit by reselling it on the market and you have money in that PIK account for $3, then you can take the PIK treasury and absorb 3 of that. And at this point, now you've got $19 debit, $20 credit. To make this balance, you actually take that one other dollar out of retained earnings. So if you sell, this is at $16, if you sell at a price below what your original cost was, then you take any money out of PIK, and then if you don't have enough money, it comes out of retained earnings. All right, hope these are helpful. The end of the semester is near, and be sure and get on any of the discussion boards or send emails if you have questions. Thanks.